All right, thanks everyone for joining us this morning for our session on the topic of valuations during a downturn. We chose this topic for a couple of reasons. One, of course, being where we're at in the market cycle. And second, we've also found that in general, in our work with startups and investors, there tends to be a fairly broad knowledge gap between the overall headline concepts, perceptions of what some of the core concepts mean, valuations themselves, but also down rounds, option repricing. So our hope today is to bridge a bit of that knowledge gap. And our guides today are partners at three of the most highly respected emerging company and startup practice groups. In their day-to-day practice, they both structure the transactions that underlie a lot of these concepts and guide and advise founders and investors on best practices and how to manage the practical implications of working with these issues. So with that, I'll kick off introductions, starting with Dawn Belt, who joins us from Fenwick & West.
Yeah, so I'm Dawn Belt. I'm a partner at Fenwick & West. I've been there for 16, 17 years. My practice is entirely with tech companies from all shapes and sizes, brand new formations, lots and lots of venture-backed companies. That's the bread and butter of my practice. A little bit of M&A. I've taken a few companies public and work with a couple of public reporting companies now. I co-lead the Startup and Venture Capital Group, and one of the things we're really focused on is making sure we're getting really good information from the market, and then being able to disseminate, interpret that, help our clients both on the company and investor side think about all of their legal issues in light of whatever the particular market conditions are.
Wonderful. Next up, Francisco Gomez Olmedo, joining us from K&L Gates.
Thank you, Quinn. That's right. My name is Francisco. I come from Seattle. I'm a partner at the corporate group in K&L Gates in Seattle, and I focus my practice on startups and venture capital financings. I think we're going to have very similar practice, description. One thing that I've been doing the last 5 years is helping foreign founders from Europe and South America to come to the U.S., incorporate their company or flip their company in the U.S. for purposes of raising funds and help them to navigate the legal system in the U.S. So, yeah. Thank you, Quinn.
Yeah, wonderful. And last but not least, Nick Markman joining us from Gunderson Detmer.
Thanks, Quinn, and for moderating today and inviting us. I'm Nick Markman, a partner in the corporate group at Gunderson Detmer. Gunderson, similar practice. Gunderson has, a dozen offices across the U.S., some locations in Brazil, Singapore, Beijing. We really only do two things, like these groups as well, but really helping startups get off the ground and helping create venture funds and helping them deploy their capital. I'm excited to be here today and talk about this topic.
Yeah, let's get going. So kicking it off, the concept of valuation often gets thrown around as though it's something of a monolith. There is a valuation that exists. Of course, in reality, there are a bunch of different types of valuations that have different meanings, different implications for different parts of growing a startup. Donna, you want to kick us off in walking through some of what are the different distinctions between types of valuations and how you see those impacting and having meaning for your clients?
Yeah, sure. So I think they fall into two main categories. There are, of course, various subcategories within that too. But first one would be kind of equity valuations that are negotiated with investors, right? Between the company and a third party, a negotiated price. That most typically happens in a priced equity round, preferred stock financing. But it can also happen through a convertible note or safe with a valuation cap, which essentially implies a particular valuation. One thing to keep in mind, particularly in a downturn type of situation, is that the headline valuation can be one thing. You just decide this is a price, and that is going to be used to calculate the price per share an investor will buy shares with. But you can actually manipulate that headline valuation. I think that's one of the things people don't talk about a lot. With things like senior and multiple liquidation preferences, with dividends, with warrants, with different kinds of structures that essentially shift a lot of economics to an investor at the expense of people who are lower down on the liquidation stack, primarily your common stockholders, your employees, founders, et cetera. But maintain a particular high headline valuation. And so that can be something that's tempting to do. It's nice to be able to announce to the public, a particular headline valuation. But that type of structuring on the back end can actually be detrimental to the company down the line. When you're ready to raise the next round, for example, how are you going to deal with a more complicated structure and structure around that again? How are you going to make sure that your employees who may not initially understand the differentiation between a headline valuation and the structure, when they realize, oh, actually I'm behind a much bigger liquidation stack than I thought I was, how are you going to keep them motivated and incentivized? So there are some different concerns like that I think are really important to keep in mind. The good news, interestingly enough, is right now in the downturn, though I've had some conversations with clients about those types of structures, most people have decided not to go down that route quite yet. And I may be curious, actually, Francisco and Nick, what are you guys seeing on that front?
From a valuation perspective?
Yeah, and particularly with are people kind of tempted by these structures to maintain a headline valuation and whatnot?
Yeah. I haven't seen, actually, even though we are kind of like in an uncertain economic situation right now, I haven't seen much down rounds.
Yeah.
I've seen more, and I haven't seen either structure financings just to keep it up. Instead, I've been seeing more like bridge financings and flat rounds.
Yes.
The extension of the existing financing they had maybe 2 years ago or last year, this year, maybe to avoid that optic situation.
Right.
I think your question was, have people been tempted? And I'm certainly having a lot of conversations.
Yeah.
And certainly from the investors, from founders, asking about these different and nuanced structures. But I think we'll probably see more of that in the year to come as the rubber hits the road with a lot of these valuations. And then there's also the set of companies that are just taking the medicine.
Yeah.
Right? Do it now versus do it later. Well, let's do it now and move on.
Yeah, and when you say it specifically, I think you mean that they're taking the medicine, do the next round at a lower price, maybe even recap some of the liquidation preference if they need to, and just set themselves up for future success, right? I mean, one of the things is you're not just solving for today when you're raising money, but what is going to be the next step? Are you going to raise again? Do you actually have a path to exit? Do you have a path to profitability? Like all of those need to be part of the calculus, not just a sexiest headline valuation I can get, right? So I think that's kind of anything you guys would add on sort of that equity negotiated valuation piece?
Well, I had a question.
Yeah.
In addition to stacking liq pref, are there other mechanisms you would say, look out for or consider as relatively common in terms of structuring mechanisms?
Yeah. I think one big one would be dividends. So if companies either are forced to pay dividends along the way, or even if they're accruing, all of that stacks up on top of the preference, right? So that's a big one. Another one would be warrants. So a lot of times people don't say, okay, I'm going to pay $10 this year, but I'm also going to get all these extra warrants, and so you're actually getting a discounted price off of that. So I think those would be the two I most commonly see. I don't know if there's some others that.
I mean, stacking convertible notes earlier in the process, doing a convertible note with a large discount in Q1, and then announcing a $20 million raise in Q4, when really a lot of that was at a discount, at a lower price, would be another thing that you do see. But to your point, I think a lot of these things are discussions at this point, and maybe we'll see more next year. But right now, I think it's evening out. We're certainly seeing these things, but I think more people are choosing to just push the conversation down the road.
Okay, other types of valuations.
Yeah. Okay. So the other one that I think you hear about are these 409A valuations, right? That's our shorthand for Section 409A of the Internal Revenue Code. Really is about deferred comp, but it speaks to option pricing, particularly in the startup world. And so these are third-party reports you get from an appraiser. And they calculate a fair market value of common stock for purposes of option grants and stock comp expense. And those valuations take into account a number of factors, notably the equity round pricing. That's probably the biggest effect, but also things like market conditions, other material events that the company may be going through, buy-side M&A, just very material change in the business, things like that all factor into this.
Secondaries.
Secondaries, of course, that's another big one. And so what happens with these is that they can be also very sensitive to market conditions. So one thing that has happened recently, and relatively recently, like in 2022, with the market downturn, right? We saw a lot of 409A valuations drop. Simply, nothing changed in the business, right? And no real material event had happened at the company, but because the markets had dropped overall, valuations came down. And then we saw that the markets recover a little bit, and same effect in the other direction, maybe not quite as dramatically, but a little bit in that direction. So it can be, these 409A valuations can be sensitive to market conditions as well. Interestingly enough, despite all these factors that go in, we typically will see in the early stages these valuations come in at somewhere in the, 15 to 20%, 25 maybe percent of the preferred stock price. And as companies age, that delta between the 409A price and the headline valuation price or equity round price tends to collapse, right? With the idea that at the verge of an IPO, they would basically be the same because that's going to be your common stock price. So that's another valuation piece that's very pertinent for employees in particular when they think about where their options will be struck. And when they exercise, what the delta is and potential tax on an NSO exercise or because of AMT on an ISO exercise. And to the point of option repricing, which we might get to later on in the discussion. But that's the other valuation piece that people should be thinking about when they think about this topic.
Yeah, it's interesting because I've seen a lot of flat 409A valuations.
Yeah.
You would think that, that wouldn't happen, because usually in a flat round, in an equity valuation, there is some negotiation, and to maintain the optics. But I've also seen, it was 30 cents a share last year, and then this year we got the same 409A valuation.
Yeah.
I think it's just interesting. I have a question though. Some founders get confused. When they see the 409A valuation, they get scared, like, oh wow, it's so low,
right.
Like, what are my investors gonna think of,
Yeah.
So we try to explain, like, hey, this has nothing to do with prospects, with your equity valuation. It's kind of like a financial picture of your company today, and it's gonna help you just to come up with a strike price for options. Right?
Yeah, there's definitely tension there between wanting kind of a high headline valuation for purposes of the outside world, but a low 409A valuation that's helpful for your employees and be able to shift a lot of value to them. So, that's definitely something to navigate, that kind of confusion. Yeah. Good point.
Yeah, and I guess related to that, in mentioning there's typically this discount on the 409A relative to, say, the price per share in the last priced equity round. What are some of the factors that underlie that difference?
Well, I think it's all the things we talked about, right? The appraiser is supposed to take into account, they have a bunch of different types of option pricing models and decide which is most appropriate for the particular company, but that factors in the equity round price. Now remember, the equity round price, they bought preferred stock, which has different rights than the common, so that there's a differentiation built right into there. But the market conditions and the other events and whatnot all are part of that analysis, like likelihood to exit, because none of that's going to get paid to until that point. Discount for lack of marketability, all of these pieces.
Yeah, exactly. Yeah, it's private companies, right? The lack of liquidity, yes.
Yeah, which applies somewhat maybe to the preferred rounds, but there's also these other attributes that distinguish as well.
Yeah.
All right, so you're a founder. You're in the situation where you're confronting either a sure down round, potentially considering a down round. Curious to hear, based on your practices, and Francisco, I'll shoot it over to you on this one. What are some of the best practices?
Yeah.
People who've handled this particularly well, particularly poorly might be instructive as well.
Yeah. So first of all, maximum respect, and for founders, because I think what they are, I think it's amazing what they do. They have to manage the company. They have to be on top of product development, retain talent. They have to do all of the hiring, making adjustments, in the workforce.
Keeping your investors happy.
Right, keeping the investors happy, so they have to wear a lot of hats, and I'm fortunate to work with many of them, and I see what they do, and I think that, great admiration for what they do, right? So, having said that, I get to work with a lot of founders, a lot of CEOs. So I've seen a pattern, of like really good practice, and some other, avoidable mistakes, that I'm happy to share. So for example, what I see in a situation like today, in a downturn, coming up with a plan, a contingency plan, and be transparent with the board, with your investors about, look, this is the situation right now. Doing an analysis of the cash flow, the runway, like what adjustments do we need to make? How far, how much money do we have until the next round? What are the financing alternatives? So coming up with a plan, making adjustments in the workforce. So I know it's tricky. It's difficult to come up with that plan, but I think it's really helpful for the board to have full transparency of what the plan is, So based on that, situations where I've seen that even not that great for a company, it's when there is no plan, and then suddenly I get a call from the founder like, hey, Francisco, we have 1 month of runway. We need to do a financing,
Yeah.
And before that, it was just the investor updates emails. It was like, oh yeah, we are doing so great. We're doing so great, And then, of course, the investors are mad. The director, is also the preferred director, also really mad at the situation. So that's something to avoid, being transparent, always with your board, and coming up with a plan, and being able to adapt, making adjustments. And with respect to making adjustments, one of the things that I don't know, you guys. I've been working a lot with companies. Reduction in force, layoffs. So that's also a board discussion. Who do we lay off? I was in a board meeting the other day, and the investors wanted to get rid of all of the sales team, and the founder was like, "What am I going to do with my engineers? How am I going to move forward with the business?" Right. So it's very challenging, right, to find this balance, right? Because you need to focus on growth, right? You need product, and sales, right? And make those adjustments to with that focus on growth is I think is challenging, right? And I've also heard the same, let's get rid of the engineers to just focus on sales, But if we do that, then the product, what's going on with the product,
Yeah.
So. Also, discussing alternatives of financing, I think is really good for founders to talk to the board about. Look, we can do a bridge financing in a safe, or we can maybe try a price round, or maybe a flat round, or maybe let's explore venture debt.
Yeah.
Maybe I've been actually doing a lot of venture debt in the last few months, and SVB is basically actually back to
in
business.
Yeah.
Also, startups with some revenues. I've also seen revenue-based financing alternatives out there. So it's just to have that conversation, right? Not get to the last month, one more month, and I'm not going to be payroll.
Right.
So it's planning, right? I think it's key. And then, I know we're talking about downturn. I mean, I don't want to be, like always like negative, and pessimistic, but I don't think we are that bad.
No,
Right?
it's not actually that bad.
I mean, I've
yeah.
seen. It's true that there have been a lot of layoffs, especially also in larger corporations. But on the flip side, we've been really busy forming new startups, like
Yes.
new incorporations. We work also with a lot of incubators, and they have like so many applications to join the incubators. So, and it's true, late stage financings this year, not so great, but seed financings,
Yeah.
we've been doing a lot, of seed financings. I don't know, do you have any ideas for good practice? Or
I just
for,
liked your theme of, plan and transparency, but I might elaborate on the plans, plural.
Yeah.
I think that's what's important, both with your counsel and your investor. Hey, this next quarter is critical. We need X, Y, or Z KPI. That's our plan A.
Yeah.
But in this environment, you really do need, and that worked. A plan A worked for the past decade, right? But now you need to be working with your counsel and whoever else is around the table to come up with a B and actually a C. And I think that's where a lot of people get tripped up. Is great. We know economic conditions aren't great. We have our plan. Let's execute on the plan. We didn't execute on the plan. Then you run into that situation where we're out of money. You need to start having conversations about payroll and the really difficult ones. And then transparency. I think the investors, we talked about founders being transparent with their investor updates, but I think, driving home that it's a two-way street, and investors need to be transparent with our portfolio companies and their founders as well, as far as their expectations, especially if plan A or plan B is an internally led round, which is you're seeing more and more of.
Yeah.
So I think those are great themes.
Yeah, it's tricky because, I mean, the ability to execute the plan, it's tough, it's difficult,
Yeah.
We've also seen many like VCs and investors wanting to hire an external CEO and kind of like the founder being like demoted from that position, and then also even demoted from as director of the company. I've seen that as a trend also a little bit in 2023, but that's just because of that. When it gets to the point there where it's like there is no plan, we don't trust your ability to execute, then it's like the investor, okay, well now I have to make these decisions, right?
Right. Yeah, I think it's really important to bring rigor to that plan. I have run into a lot of situations where people think, oh, I have 6 months runway, and it turns out, no, if you look at it really hard, you only have 3 months or whatever it is. You can't assume that everything is going to go exactly right, like you were saying, Nick, and it can't just be plan A. You've got to have the scenarios really locked down and be able to adjust to that. So I think that's really important. Another thing you mentioned, Francisco, I just wanted to touch on, and with the layoffs, although very unfortunate, particularly with the big companies, I had a lot of startups that actually were very excited about the access to the talent that they could not get for a number of years, where we were just desperate for engineering talent, and there was none to be had because it was all just swept up by the big companies. And now I actually think it's a great time to start a company. That you're able to get people to come help you. The access to resources, the number of tools that are off the shelf and available now, it's just nothing like when any of us started practicing, right? And how much harder it was for founders to start companies. And now there's just so much you can get open source or through a very inexpensively that just to help you get launched. And then the seed funding is available. That this is the place where investors have moved their attention. And they're looking for opportunities to fund. So this is a great time to start a company.
I'm constantly surprised. I mean, once a week I'll have a client that's getting not just a term sheet but multiple term sheets.
Yeah.
It's kind of my first impressions. What year are we in? Right. Valuations aren't as aggressive, but it's just to put some substance behind your comment. It's happening. There's still fundraising happening for sure.
And one thread I'll just pull on a little bit because I think it's a theme that came out of this. We expect founders to maintain an irrational level of optimism. It's a job requirement.
Yes.
Yeah.
And this is one of those occasions where you have to pair that with some, the rational optimism.
Yeah.
And every now and again you have to be able to hold both those things present at the same time. And this is one of those times.
Yeah.
I guess on that note, that's a good segue. To talking about, you're faced as a founder or an operator with a down round. What next? How do you best handle that? How do all of you advise clients in your practices where to go from there? Whether it's how best to communicate it, how best to plan the path forward. Nick, I'll start with you.
Absolutely. I liked you pulling on that thread and mentioning kind of the optimism that you need to have. So maybe I'll take that piece of your question and focus on kind of the silver linings when there is a down round. And I think Don already mentioned one of the key ones, which is talent and the access to the resources. But really, I like to frame it in three big buckets when you look at what's next and how you frame it and how you deal with the questions of morale with your investor base, your customers, your employees. And the first is just expectations and the opportunity to reset expectations. The next one is kind of market and market projections. Often you're raising in a very difficult time, you're actually able to project some strength. And the third bucket is that talent that I think we should dig in a little bit more, because it is a very exciting time, both founders spinning out of these large orgs and getting positions that were open, with 0 candidates for years, multiple people. But on that first one with expectations, I mean, it's rare when you have a company that's redlining day after day, week after week, to just say, hey, time out. What are we doing here? Are we chasing revenue to the moon, or are we actually going to plot out a path to profitability? Are we going to make some mature decisions here, decisions that maybe are difficult decisions, and have everybody come and recollect themselves and project just new plans, which is good. As far as my comment on kind of market perception, I guess it's important to say that down rounds don't kill startups. Running out of money does. That's the number one thing that kills a startup. And so if you're actually fundraising in a difficult situation, like that's strength. Your competitors are going to note that you're raising a decent amount of money, not necessarily that it's a lower round, but a decent amount of money. And customers will note as well, hey, this is a going concern. You look at some big, Quinn and I were fortunate to hang out last night, and we were talking about companies that had been through down rounds. Airbnb in the middle of COVID, massive down round. That's a very good asset right now. Stripe just had a markdown of 65%. Quinn, you reminded me of Facebook right before their IPO, but these are great companies. And if done right, if a down round is structured right, and not just structured on the legal end, but also structured in the way you communicate it to everyone, it can actually be pretty powerful. And then the last bit, actually two things that Don mentioned, was just the access to talent, but also 409As, and how that impacts kind of the common currency, which is stock options, and how you incentivize people. Those are two things that have been kind of diminished over the past decade increasingly. I think the ability to attract new talent, from the big players in the Valley and elsewhere is unparalleled, something I haven't seen in a long time. Multiple resumes for CTO positions and the like, and curious to hear what you guys have to say as well. But then also retain your talent. It's kind of a paradox when you say, wait, you're telling me this is a good thing for retention when you have a down round, valuations are going down, but you can actually reprice those options so that people have more economic upside in the long run. I'll pause there.
I would maybe add, curious what you think. So sometimes in a down round situation, kind of like people start panicking, and founders as well, kind of like, and they start kind of like in this desperate mode of doing everything at whatever cost, and I think it's just hard, for founders kind of like to find that resilience, and moving on, and not kind of like giving up things that, for example, I've seen situations where, like, oh, we are in a down round situation, we need to get these commercial agreements right away, and we can show traction, to investors, and then we're just willing to give up, I don't know, equity kickers, or stuff like that, So it's kind of like, take a deep breath, like you can do this, So I think that I'm saying, like, from an emotional perspective, it's hard to get to that position of like, yeah, we can get something good out of this,
It's a tremendous amount of emotion.
Right? Yes.
from all parties, and it comes to a head with down rounds, certainly.
Yeah, I mean, it's just sometimes I feel like we are more like counselors than counsels, for our startups, clients.
Quinn, should we touch on that, the 409A and option repricing at all, or is that?
At least elucidate. So when you say options are repriced and there's this opportunity to level set, I do think taking this opportunity to pause and set forth a new path forward is you don't have that many opportunities to do that when you're building a company. And part of that being, this opportunity to reprice options and there being a clear external reason to do so. What does that mean, and what does that kind of look like practically for a founder who's contemplating that? Why might you do that? Why might you not do that?
Yeah, no, absolutely. As I mentioned previously, kind of the common currency is the employee stock option. And it's hard to retain people with just a valuation that's uncoupled from market reality. So what a repricing does is really bring that price down to incentivize people again.
And when you price, you're talking about exercise price on the
exactly,
options.
the exercise price. So earlier we were talking about 409As and that being a component of when we say valuations are down. There's equity valuations are down, there are capped valuations that are down, there are 409A valuations that are down. And when I say reprice, I simply mean bring a previously high strike price down to the lower market strike price so that any upside with the company is realized not just by the investor group but by the employees. It's extremely tax driven in a lot of different ways, and it's always fun to be talking tax and getting in the weeds on a Friday. But at its core, that's it. It's taking a previously high valuation and giving it to employees at a lower valuation.
And
so maybe just as an example, right? So if I had last raised at a $200 million valuation, right, and I was striking options at $2 a share, but now I had to do a down round at 100 million, and then maybe my 409A after that round is now down to $1 a share. Well, if I reprice my options, people who have $2 options now can have $1 options. That's shifting $1 of value, to them when the company goes back up, right? These are all made-up numbers, of course. But the idea is that with a new 409A that will be down, that follows a down round on the equity piece, you've just got this opportunity to give people the opportunity to grow again with the company, kind of reset their expectations, right, and start anew. And sometimes that's a hard conversation because you're going to somebody and saying your stock is actually worth less. And it's like, yes, that's true, but we're going to start you off from a lower part of the ladder as well. And as we climb, you're going to get more and more of that delta. So it's a generally good thing to do. Figuring out the messaging can be difficult, and that's always a part of just how do you talk about this with your workforce? But overall, I think the pros really outweigh the cons of going down the repricing route when you can.
And just to be abundantly clear, I know we all mentioned it, but that would be both retroactively and going forward. So people who had options 3 years ago at a high price would now come down, as well as new employees that are hired.
And that could be very impactful if, for example, my options are out of the money. They're essentially, if I exercise them today, they're worthless, and you can amend the exercise price, and all of a sudden.
But who exercises the options?
Fair question.
People who want long-term capital
Right,
gains.
like usually, in practice, right? Like you just wait until there's a liquidity event, I mean, so even though it's all the tax-driven situation, I get it, but at the end, is the end picture, It's like.
But you still need the reprice.
Of course.
You still need fundamentally need that action to occur.
Yes. Another thing that I've seen, and I don't want to make this very popular among you guys, but it's the also executives or high-level employees negotiating post-termination exercise periods longer, because usually it's 3 months. Usually it's 3 months after you are terminated or you leave the company. You have 3 months to exercise, or otherwise the options go back to the pool. I've seen negotiations of extending that maybe to like 6 months or a year, even though they might have a tax impact, but I've seen that too as well, as a mechanism to retain talent as well,
Yeah, I've seen that trend going back quite a while, not necessarily coupled with kind of the downturn in the market.
Yeah.
I think Pinterest, I should date myself here, I've been doing this,
10 years
have to
ago,
count on my
right?
fingers
Yeah.
and toes at this point, but I think Pinterest really kicked that off, and a lot of the large emerging unicorns really followed suit with 7-year exercise periods and things that were great, and something that was needed to attract talent in that ecosystem, absolutely.
Yeah, we see some of the talent attraction mechanisms now being shifted over to
Swinging
retention.
retention and smaller enterprises being able to use them. So
Yeah, and then they offer also for retention, for like give the employees some liquidity programs, right? And stuff
Actually,
like
that's a good question. Have you guys seen any trends in terms of?
I think in a downturn, they're
Yeah.
much less.
cash is king.
So right, that's right. And so I think when we had the, I don't know, is there a name for the pandemic boom or something like that? But
Not yet.
well, not yet. But maybe I'll trademark that one. Anyway, during that time, we were seeing a lot of tender offers,
Yeah.
right? When investors were really trying to push money out into the system as fast as they could. I haven't seen any in a while, as I think some secondary activity, yes, but full-on big tender offer transactions, not so
I agree.
much.
Related, in terms of what you guys have seen over the course of this down cycle or this market cycle overall, anything you'd expect to see change in terms of the structures of employee compensation, the way companies are capitalized? Do you think we'll see any structural shifts on the back of what happens over this year, next year, however long this sort of down cycle lasts?
Not dramatically, I don't think, but people are just being a little tighter with budgets, right? More discipline. Maybe you're not going to get as fancy office lunch. I don't know, but just a little more discipline. But I haven't seen anything drastically change.
No. I'm curious about the changes at a federal level at the non-compete provisions, if that will help. To attract more talent. I know here, non-compete are not enforceable, but I wonder if we're going to see that more often in other states. What happens, as a way to, make it more, easier for companies to hire talent from other companies. We'll see.
As far as the trends, because I'm a nerd, I randomly every now and then pull out like deal terms from when I started doing this just to compare. And I think, that's on the decade plus life cycle, right? But and then I pull out ones that I haven't done that are even older. And I think, it's interesting. You see things like mandatory redemptions, multiple liquidation preferences, seniority on stock and things like that you still aren't seeing despite the pendulum starting to swing. And I think that's going to be the norm for certainly the year to come, and certainly the near-term future. Is we have kind of coalesced around what we're seeing now. But as some of the other ancillary things that we mentioned, I think are going by the wayside, the secondaries and whatnot. But we'll see. Time will tell. I've been wrong on occasion before, as you know, Quinn.
Yeah. Well, it's interesting to see that the psychology kind of translate itself into terms in financing agreements, and it seems like we're somewhere in the process of that happening, but more to come.
Sure.
Wanted to leave some time for Q&A here. We have one question from the audience relating to 409As. What happens to those employees who early exercise options and 409A gets revised downward?
Do you want to be the bearer of bad news?
Sorry, man.
Yeah.
Not much we can
The
do.
headline is sorry, but really that's where this next layer. The headline is sorry, right? You maybe took a little gamble, and you can't reprice that one. But the subheadline is actually a bit more optimistic, right? If you have someone who's still at your company that early exercises, you want to incentivize them. I've seen companies, on the back end, giving a re-up with different or nuanced vesting terms, or some sort of spot bonus to comp them or bring them whole. The point is, if there's a talented individual in an organization, the organizations going to want to keep them there, and do what they can to keep them there, without setting a dangerous precedent across whatever department they're in.
Yeah, but yes, I agree, and also, if that person exercised, you have a stock, and then the time start ticking for capital gains tax treatment and potentially QSBS. You know,
sure.
so if you have an option and then you don't exercise or you don't get exercise until there's a liquidity event, the proceeds that you receive from that transaction is ordinary income, right? But if you had exercised, the time start ticking. It's just 1 year for capital gain or 5 years for QSBS, right?
For sure.
So maybe it's not too bad, I mean, it's long term. You don't. I mean, maybe today doesn't look great, because the 409 valuation is lower, but who knows? When there is an exit, maybe it was a good decision,
Yeah, this is somebody who early exercised versus they just had previously exercised.
Early exercise.
Yeah, and I don't tend to see a lot of early exercises where people actually have to write big checks. Most of the early exercises are at quite low value, so a drop in 409 might not affect them, right? So if I got my option at 5 cents and the repricing was in my prior example from $2 to $1, right? It didn't affect me anyway, irrelevant, right?
Yeah.
And people tend to not write very big checks to early exercise. Everyone's got a different risk tolerance on that, but the taking risk today in order to maybe get a tax benefit in the future when if you believe in portfolio theory, generally, when all of your time and energy is already spent in this company, might or might not be the best way to think about your overall financial portfolio, but not my area of expertise. But people who have they left the company and they had to exercise or otherwise would lose it, they're a little bit they're out of luck. But they potentially could have some upside on the tax piece down the line. Look, I think when you go and work for startup and technology companies, you are taking a little bit of a risk. Part of the culture is, you go in and you do kind of hope for the best. And if you feel good about the company when you're ready to leave, exercising, figuring out how to exercise within your means, right? May be an upside, but you got to figure out that you got to definitely take into account that there's no guarantee in any of this, right?
Well put.
Yeah, and that goes back to why some of those extending the exercise window can really help because it allows it defers that
Most
decision.
people would take that no risk now, even at a less optimized tax situation, versus take the risk now with real money that you had to earn someplace else for only a potential tax upside.
Yeah. All right, another question from the audience here. Is it possible to reprice options for a startup that is now considered to have a lower valuation than it did during its most recent round? And should any startup even consider that? I think I'm going to rephrase this slightly because I think what they mean to ask is, can you reprice options even if you haven't raised a down round?
If you get a new 409A valuation that's lower, yes, with a warning. I'm sure you guys will jump on that too. You can't just reprice left and right, right? Like if it starts looking like every time the stock ticks down, I reprice, it's sort of a bit of a sham on how you think about valuations. So with our clients, we generally have a rule of thumb of you can only pull this lever so many times in the career in the lifetime of the company. So if the price only came down 10 cents, 50 cents, or even $1 in my example, you might opt not to use one of your few bites at this apple on something like that, and you wait for the big repricing where I drop from like $10 to $2. Like, you better reprice that.
I guess a question that the company, the management need to think about is the repricing really going to help me to retain any talent?
Exactly. That's bingo, right? That's the question.
Right? Because
so for 50 cents, it doesn't do anything. Right. For $8, it probably does, right?
Yeah, Don's point was the floating exercise price.
Yeah.
If it's every Monday you have a new one, they'll say, guess what, you don't have, this isn't an actual viable instrument. And you want to avoid that. So really structuring it for maximum impact with your retention within the parameters that the code allows is the bullseye there.
In this vein, are there alternatives to repricing options that you guys see? Of course, if you're not getting any benefit from repricing, are there other tools, mechanisms that you sometimes recommend for getting at the same idea of either motivating or retaining talent? I guess obviously issuing more options at a lower valuation.
Issuing more is easy. Things that are not necessarily compensation driven, but how do I make people's job more interesting or feel more esprit de corps or whatever it is. Those are all impactful. Looking at other kinds of equity instruments. I tend to not like those because until you get to a particular size where it makes sense, just more complexity is not necessarily the better answer in most of these situations. Stock options, despite being somewhat part of the cocktail conversation in Silicon Valley social circles, most people actually still don't understand them as well as they should, and layering on more complexity with other types of instruments, I hesitate to go there until you're really at a place where options don't work for you as an incentive tool.
Cool. Well, on that note, hopefully we've left people a bit more informed. Thanks to all of you, for joining us, and thanks to those of you who joined us online.
Thank you.
Thanks.